Do-it-yourself investing offers you more control over your investments and often much lower fees. However, there are a lot of hidden challenges that could end up costing you tens to even hundreds of thousands of dollars if you're not careful. So in this video, we'll go through 8 of these challenges that you must prepare for if you want to succeed as a DIY investor. The first challenge many face is time commitment. Being a DIY investor takes a lot of time, and if you want to do it properly, you need to put time and effort into knowing how to read financial data, watch quarterly reviews. There's a lot of information out there. Knowing what's right, good, and worth following takes a lot of time. To do research to figure out what stocks, bonds, and any investment to buy, it takes a time commitment. And for many people, they don't have that time commitment. And that's where that balancing act between, do I pay someone to do it, i.e. value my time and hire out for what I don't want to learn, versus DIY investing. No, I want to learn this. I want to put the time commitment into this. And that's where a lot of DIY investors really do thrive. They want to learn, they want to educate themselves around how investments work, what should I be buying and selling, and how does my money work better for me? But again, DIY investing takes a lot of time. So before you jump into it, make sure you have time to commit to it, because moving to DIY investing from a traditional model can be a great solution like I talked about. But if you don't have the time and the time commitment to put into it, there's going to be challenges. The second factor with DIY investing is emotional decisions. And I see this all the time as a financial planner around investors and how they think and how they make decisions emotionally. And this is around your investments. That's around, we see it all the time with the Canadian pension plan, right? We move things from a financial decision to an emotional decision. And emotional decisions around your finances can go really bad for you. In fact, they can cost you hundreds of thousands of dollars. As an example, taking your Canadian pension plan at the wrong time could cost you up to and even over $100,000 through your retirement. That's a very large financial decision that you're making on emotion. And so when it comes to DIY investing, you need to understand, what's my game plan for the emotional side of it? When markets drop, what am I going to do? How am I actually going to react? And for a lot of you, my recommendation would be test it, right? Don't jump in with both feet, test it out. Now, we've had a couple years of really good markets. The markets will drop at some point here going forward, when nobody knows, but when they do, how are you going to react? So instead of maybe jumping with both feet, have some test money and see how you actually react to markets when they go down and how you manage your portfolio, because emotional decisions around finances is a huge part of it. And having that trusted advisor on your team can help walk you through those emotional decisions. We do it all the time with our clients. So again, if you move to the DIY side of things, make sure you have either that trusted advisor or a really clear plan around, what am I doing emotionally when certain things happen within my portfolio or the market as a whole. DIY investing can also create missed opportunities. And what I mean by that is, typically we invest in things we know. And that can be a great solution. I remember back in university many years ago doing an investing course. And the instructor was like, you know what, a great place to start investing is just look around you. What companies do you like? Do you enjoy? And at that time, Apple was just coming up. Lululemon was coming up. Like, some of these companies, I look back at the stock price and think, if I threw some money in Apple, shortly after I graduated, I don't know if I'd be here today. I might be retired at that point. So again, companies that were great, we saw the opportunity. I had some of the original Apple products and they were fantastic. So the quality is there, and that's why we tend to invest in things that we see and feel and touch. That's why people like real estate, right? They can see it, they can feel it, they get their annual statements. Like, it's a tangible asset. And so for many DIY investors, their go-to investment is, what do I know? I talk to a lot of people that work in the oil and gas sector here in Canada, and if they're DIY, I would say 90% of the time their portfolio is fully constructed of oil and gas companies, because that's what they know. But again, are you missing out on opportunities? Are you over diversified in one area, or maybe under diversified as a whole market? So again, that's some of the risk. There's obviously opportunity there too. As a DIY investor, you know your field well. There's maybe some opportunity there, but don't miss out on the diversification piece. Make sure you are diversified across many sectors, countries, all of it. There's more to it than just jumping into what you know. Again, might be a good place to start, but it's not the end all of what you need to do as a DIY investor. The fourth thing I want to talk about is more of an opportunity versus a downfall of DIY investing. And that's tax inefficiency. And I would say it's tax efficiency. So a lot of you move out of your traditional mutual funds into DIY investing. You're tired of paying high fees, getting nothing for it. So you move to DIY, which can make a lot of sense. And it's hard to argue that at all, because you're being gouged over here. You're paying high fees. You're not getting anything for it. You're getting shoved into mutual funds. And typically there's not a lot of tax efficiency there. And so moving to a DIY investing structure is you typically have more control about what goes where. And so you can look at your RSP and your TFSA and your non-registered account and your types of accounts and create tax efficiency within those types of accounts. Now, I think we can nickel and dime that a bit sometimes, but there's definitely opportunities for tax structure when you have DIY investing. When you're looking after your own portfolio, like I'm going to put my equities, in my registered and TFSA and keep my fixed income in my non-reg, right? And you can kind of create some tax efficiencies within your portfolios. Whereas your traditional portfolio, at a major financial institution is just you own ABC fund, like the balance fund, the growth fund, and it's just in all your accounts. I see it all the time. If you have non-reg, RSP, and TFSA, those three accounts, you'll have the balance fund in all three accounts. But does that make the most sense from a tax efficiency standpoint? Typically not. And so moving to DIY, you can kind of manipulate a little bit better. Again, it goes back to number one that I talked about, time commitment. It takes time to figure out what is that tax efficiency? How do I create that? What does that all mean? You need to do that first. But once you figure that out, you maybe create some more tax efficiency within your overall portfolio when you're doing DIY investing. The fifth item costs you the most money as a DIY investor. Most of these fees are hidden that you don't even know you're paying. And that's FX fees, so currency exchange and trading fees. Now, there's a lot of platforms out there nowadays that offer free trading. Wealthsimple is an example here in Canada where you can trade for free. But for the majority of Canadians, as you do those transactions, if you're buying a US stock, then you sell it. First off, moving your currency from Canadian cash to US cash to buy that, say, Apple stock, you're paying a 1.5% transaction fee. When you sell the Apple stock, they convert it back to your Canadian dollar, another 1.5% transaction fee. So you paid 3% in and out of that Apple stock just in transaction fees. So if you're doing $1,000, you're paying $30. If you're doing $10,000, you're paying $300. It's a very large fee. So just because they have free trading doesn't mean that there's other fees and transaction costs in the background. These companies make money some way. They don't do everything for free. How are they making money? You need to do your due diligence. And every trading platform has different structures, different fee structures. Some are better than others, and it'll depend on what you're looking to buy and how you build your portfolio. But for many of you, you're spending hundreds to tens of thousands of dollars. I'm not kidding you, tens of thousands of dollars every year in fees on FX, currency, back and forth currency. So take a look at your portfolio. When you buy a US stock, are you converting from Canadian cash into US to buy that? And when you sell it, are they converting it back to Canadian? If they are, what is that fee? That's going to be adding up. And again, every transaction you're doing, it's adding to your costs. So there may be no transaction fees, but you're paying 1.5% potentially in the background on currency exchange. And that's costing you a lot of money. And speaking of high fees, let me introduce you to moomoo, the award-winning trading platform trusted by millions of investors worldwide. Moomoo's parent company is publicly traded on the NASDAQ with global user base of 23 million people. Moomoo is also a member of CIPF, which protects security clients of its members up to 1 million per general account. Now let's talk savings. Moomoo offers some of the lowest trading and FX conversion fees on the market. For many of you, you're paying well over $1,000 per year in hidden currency exchange fees like I talked about. For example, converting $50,000 with most brokerages will cost you 1 to 1.5%, or $500 to $750. With moomoo, it would cost just $47. Extrapolate these fees out over many transactions per year, and your low-cost DIY investing may not be so low cost. Moomoo's low fees combined with no account management costs and advanced trading tools make moomoo the smarter choice for Canadian investors. Plus, their user-friendly app supports TFSA and RSP accounts, extending the benefit even further. To top it all off, moomoo now offers generous sign-up benefits for new users. Sign up with my link below, make a qualified deposit, and you could earn up to $200 in stock cash coupons, plus for a limited time, 6% APY on idle cash for 2 months. With recent rate cuts, this is a rare opportunity. Additionally, if you transfer your investments to moomoo, you can earn up to $2,300 in cash rewards. And as a bonus, for the first 50 people that sign up with moomoo using my link below and make a deposit of at least $100, I'm giving away our masterclass valued at $100. So if you're looking to get access to our masterclass for free, you can sign up for moomoo for lower trading fees plus all these additional bonuses. Links below. The sixth tip I have for you as a DIY investor is to create an accountability group. And these are people that are doing research, time commitment, have a mindset like yours. A lot of the problem with doing DIY investing is you're in your little silo, right? You go to your little office in your house and you kind of do your own little research, but you don't really open up the window too much. And so I encourage you, if you're a DIY investor, one of the challenges is accountability. Who's holding you accountable to the transactions you're making? And this is the case for a lot of advisors out there. They're one-man shows and they can do whatever they want for their clients. There's very little accountability. That's why I like having a team manage my money. But again, as a DIY investor, you need to create that team around you. And it could be other DIY investors that think like you. There's a lot of online platforms, chat groups, that kind of stuff that you can join. So I encourage you, if you're walking down the DIY investing route, to look at options that will help you connect with more like-minded people to just bounce ideas off of. Whether it's video, whether it's chat group, whatever it is, find that connection. The seventh thing, and I see it all the time, is overconfidence bias, right? We've had really good markets. I've made a lot of money. I'm an expert at this. And man, do I see that go south. I mean, when COVID hit in 2020, we saw markets crash. A lot of DIY investors sold out. They didn't know when to get back in. And this is always something I say. It's easy to buy good companies. It's hard to sell good companies. And that kind of ties into retirement. As you get into retirement planning, all these great companies that you bought, you need to liquidate. Unless you have a big enough nest egg that you can actually hold on to the asset and just live off dividends, interest, that kind of thing. But for most Canadians, 99% of you, you need to start liquidating your portfolio in retirement. So what does that look like? And as you go through the process and build up to retirement, this overconfidence bias can really hurt you. So don't get too caught up in the high times or the low times. Find a median. What is your overall target rate of return? So if it's 8%, how am I doing? If I got 15, I'm probably going to have a year that's down. And I think a lot of us forget that there's down years in the market and they need to happen, right? They create an efficient market. And it's not trying to time it and get out of the market and buy at the very low. And no, for most of you DIY investors, it's buy and hold. Buy quality companies, hold them, nurture that investment over time. But for a lot of you, when times are good, you forget that the bad times are coming, and they are coming, and they'll probably come many times over. So again, how are you preparing for that? It comes into like the psychological mindset as well. And that's why I think it's good to have people around you that you can run ideas off. Like, how are you structuring? Okay, we've had 15, 20, 30% rate of return. What does that mean for the future? And how do I make sure I manage everything properly? So when that comes, I'm prepared for it, both mentally and financially. The last thing would be opportunity costs. And a lot of DIY investors, they take advantage of this or they lose out on this. And this goes back to number one, spending time doing your research. And for those of you that do your research, opportunity cost is a value add as a DIY investor. You can look at opportunities, take advantage of them, get invested in stuff hopefully early on, and go back to my early Apple days where I saw a good product, but I didn't invest in the stock, and I should have. Again, wouldn't be here today maybe. So where are those opportunities? Where are those opportunity costs? And for those of you, many DIY investors are losing out. That opportunity cost is lost because you haven't made the full commitment into DIY investing. So just as you tiptoe into DIY investing, make sure you look at, like, what's my time commitment? What's my team around me? Am I going to have opportunity cost or opportunity benefit? What does that look like for me? For most DIY investors, and I talk to many of you every day, and I know typically a financial planner like myself isn't saying DIY is a good option, but it is a good option for many of you watching this video. Now, a lot of you shouldn't be DIY investing that are, and those people understand that eventually this is going to catch up to me. You need to find that middle ground. And so again, I always say most people move to DIY investing because they were paying a very high fee at their bank or financial institution. They weren't getting a lot for that. They got frustrated. They moved to DIY. DIY investing, the platforms are there, ETFs are there. Like, it's very easy to do it nowadays. If you backtrack even 5, 10, 15 years ago, it was very tough to do DIY investing. That market is opening up, and I think that's why, as we offer fee-for-service planning, which is more of a consulting service, we have a lot of DIY investors. Look, keep managing your money. Our team will build out a plan, map it out, give you that strategy. You can continue to implement it going forward. It's a good marriage there. But for a lot of you that are doing DIY, I think it's time to reevaluate it to figure like, is this the best thing for me going forward? Am I in the best position? Am I doing the best thing for my money? Sometimes paying a fee is worth it. And that's where you have to figure out like, yes, no, I'm good at it. I'm putting in time. I'm doing everything Adam talked about today. Or you know what? No, I just don't have the time anymore. I don't have the interest. For a lot of people that do DIY, when they get to retirement, they don't want to deal with it anymore. They want to go, spend their time in Phoenix and relax and not worry about investing their money. So again, there's kind of a time and place for DIY investing for most Canadians. And I think there's opportunity out there, but I think a lot of you need to take a step back, go through this list that I talked about today to figure out like, is this really for me? Or am I better off like kind of shuffling this off to something else? I'm not saying go back to the high price financial institution. There's other middle ground options out there where the investment decisions are taken off of your plate and put onto someone else's for a very small fee. Again, if you're someone that really loves the DIY, I say keep plugging away, keep it doing your thing. As long as you feel confident in it, and as long as you're following along with the 8 tips I gave you today, you'll have success. So my challenge for you today is to go into your investment accounts, look at what you're paying for fees for your FX. If you're paying a lot of money on your FX, take a look at moomoo. Again, we've linked that below, but you want to check them out because their FX currency fees, I noticed that on my accounts, my DIY investing accounts that I have, kind of my plain money, I was paying a lot of money on FX. And I knew it, but I didn't know a better solution, but now I do. I've moved to moomoo, I'm saving a lot of money in transaction fees, in currency, all of that. So check them out, I'll link that below. If you're paying too much in fees, they're a great place to start.